Good evening, students. Welcome to the session. So, have you revised what we have discussed in the last class so far? Yes. So, last time we were doing the taxation of various instruments. Have you revised that? Yes or no? Yes. Any questions so far? We had started with the bonus shares last time and the rights issue, right? So where we saw what is the cost of acquisition in the case of rights issue when you renounce the rights, and in the case where you subscribe to the rights and then sell those shares which are received under the rights issue. So what is the taxation for that and how basically the cost of acquisition is determined. Yes, do you have any questions so far? Good evening, Oja. No doubts? Okay, so let's proceed further. So now what I'm going to do is I'm going to discuss now about the other instruments that we are left with. So first we will start with the ESOPs, taxation of ESOPs. Now what are ESOPs first of all? Yes. What are ESOPs? You have studied about the ESOPs. Yes, students, please faster. Oh, there is an echo in the voice. 1 second.
It's
Give
okay,
me a
ma'am.
minute. Echo हो रहा है क्या?
No, ma'am. It's okay.
ओके है ना क्योंकि
I
स्टूडेंट्स का
think there,
मैसेज आ रहा है कि एको हो रहा है.
no, ma'am, there is some issue from student side.
Okay. Ginny, you can check at your end. Maybe there seems to be some issue in your server. Okay. So let's proceed further. So we have discussed about the rights issue and the bonus issue, right? Now I'm going to proceed towards the ESOP. And before we move towards the ESOP taxation, let us solve one question particularly from the point of view of the rights issue and the ESOP. So that will also make it clear. And then, of course, we'll proceed towards the ESOP taxation. So let's write one question. Yes, Ginny, you can rejoin again. Okay. So, Mr. A purchased 1,000 equity shares in ABC Limited, an unlisted company, at cost of rupees 30 per share. Okay. Brokerage is 1%. In Jan 1996, he gets 100 bonus shares in August 2000 and 1100 bonus shares in Feb 2006. FMV as on 1/4/2001 is equal to rupees 80. On 1st January 2024, sorry, one second. He transferred all the shares at the rate rupees 200 per share. Brokerage is 2%. So you have to calculate what will be your capital gain. Yes. Now, okay, Jimmy? Okay. Yes, students, please calculate the capital gain for me. Yes, please calculate. First, we'll calculate for the 100 shares, isn't it? So 1000 equity shares. What will be your capital gain? Faster students, please tell me. What is the capital gain on 1000? First, I will calculate on 1000. What is my sale price? 200 into 1000, 2 lakh. Then expense on transfer, which is my brokerage, right? How much is the brokerage? 2%, 4000. This will be 1,96,000 minus the cost of acquisition. What is the cost of acquisition, students? Assuming for the time being that there is no indexation. Echo आ रहा है क्या?
Ma'am, echo is coming, ma'am.
Little bit,
Okay.
ma'am.
Okay. Let me 1 second do it.
मैम आप अपने लैपटॉप का जो स्पीकर है ना वो बंद कर दीजिए।
अब बराबर है क्या?
या मैम स्पीकर बंद है मैम।
एक ही सेकेंड ना, एक मिनट।
स्पीकर का वॉल्यूम जो है ना मैम वो 0 कर दीजिए, नहीं आएगा फिर इको।
Okay. So students, what is my cost of acquisition? Please tell me that. You have to be really quick about these answers because this is nothing difficult.
FMV as on 2001.
Huh?
FM fair market value as on 2001.
Yes. FMV as on 2001, you will take, which is 80, right? So 80 into 1000, right? At this moment, I'm not going into whether indexation is applicable or not. So assuming the indexation is not applicable, so yes, you're right. You're 80 into 1000. So this is going to be 2. 80 into 1000 is 80,000. How much will be my capital gain? I will have a long-term capital gain of 1,96,000 minus 80,000. How much it comes to?
1,16,000.
1,16,000. Right? Now let's come to the bonus issue. Now bonus is first 100 equity shares. So what will be my selling price of the another 100? 20 into 100, which is 20,000. What will be my expenses on transfer? 400, 4%. Right? This will be 19,600. What will be my cost of acquisition in this case? What will be my cost of acquisition?
Cost of is 0, ma'am.
0? Yes, is whether it will be 0 by any chance? Yes, give me. You are right. It will be 80 into 100 and not 0. Because if you see in the last lecture, what I had taught you, if you look at this particular chart that we have done. So if I have the bonus allotted before, if I have the bonus allotted before 1st February 2018, then and on which STD is paid at the time of transfer, it will be either nil or FMV as on 1/4/2001 if acquired before 2001, FMV as on 31st January 2018, or the sale consideration, whichever is lower, and then the higher of these amounts. Right? So now if I consider over here, the 100 bonus shares have been given to me in August 2000. Right? 100 bonus shares have been given to me in August 2000. Now these are unlisted. This is not at all listed. So if I have been allotted before 1/4/2001, it will be nil or FMV as on 1/4/2001, whichever is beneficial to the assessee. So I will take the FMV as on 1/4/2001 if the bonus shares are allotted to me before 1/4/2001. So it will not be nil because if I take the nil, it will not be beneficial to the assessee. Are we clear? Then in the last scenario, when another 1100 shares are issued, so 200 into 1100, which is 2.2 lakh, minus 4,400 is brokerage. So this will be 215,600. Here, what will be my cost of acquisition? Yes. What will be the cost here? Faster, students. What will be my cost?
मैम
Yes.
यहाँ पे हमारे पास 31 जनवरी 2018 की वैल्यू तो है ही नहीं, तो फिर हम कैसे यानी जो हायर और लोअर वाला कैलकुलेशन करेंगे?
नहीं, वो लिस्टेड शेयर्स की केस में है. हायर एंड लोअर वाला इफ यू सी दैट इज इन द केस ऑफ लिस्टेड शेयर. So see, I have given the chart of three. If you see, allotted before 1/4/2001, allotted before 1 February 2018, on which STD is paid at the time of transfer. Now STD will be paid only on listed share. So this is an unlisted share, so that will not be applicable. So we will only consider the first part, which is allotted before 1/4/2001.
ओके मैम.
Yeah.
यस
Now what will be the cost in this scenario? What will be my cost? Fast. Yes, students, please tell me what will be the cost. It will be nil, right? It is allotted after 1 February 2018. So here my cost of acquisition will become nil. So these 1100 shares were allotted after 1st February 2018. So students, in the case of bonus shares, if allotted before 1st February 2001, the cost will be nil, but you have to substitute it with the FMB as on 1/4/2001 if that is more beneficial. If the bonus shares are allotted before 1st February 18 and on which the STD is paid at the time of transfer, then in that particular case means it's a listed bonus share. In that case, you have to consider the first lower of FMB as on 31st Jan 2018 or the sale consideration, whichever is lower, and then you have to compare with the value which is FMB as on 1/4/2001 if they were acquired before 2001 or nil, whichever is higher. And if they are allotted after 1st February 18, then in that particular case it will be nil. Are we clear? Yes or no? Is bonus issue clear to all the students? Any questions so far? Yes. Yes, students, any question?
एक्सक्यूज मी मैम.
Yeah.
मैम इसका मतलब यहाँ पे भी भले यानी ये फरवरी 2006 को अलॉट हुआ है, लेकिन फिर भी हम इसको बिफोर 1/4/2001 ही कंसीडर करेंगे?
नहीं, हम 1/4/2001 नहीं कंसिडर करेंगे, क्योंकि अगर आप यहाँ देखो तो यहाँ पे he gets the 100 bonus shares in August 2000, that is before 1/4/2001, and
Yes.
1100 bonus shares in February 2006. Now February 2006 में जो मिले हैं उसके ऊपर आप तीनों इंस्टेंसेस ऊपर वाले में नहीं जा पा रहे, बिकॉज इट इज नॉट अलॉटेड बिफोर 1st February, इट इज allotted before 1st February 2018, right? However, it is not a share which is the listed share, because इसके ट्रांसफर पे हमने STT पे नहीं किया है, क्वेश्चन में ऐसा कुछ भी नहीं दिया हुआ है.
हाँ.
Then even the second case is not applicable and third case is also not there. So any which ways in that case the bonus share का cost will be nil.
ओके मैम.
Okay. Yes. Any doubt? Any questions so far? Yes, students. Is this absolutely clear? So chalo, we'll do one more question on the rights issue and then we will go to the ESOP taxation. Okay. Now again, you are going to solve for the rights issue. So let's write one more small question. These are small examples that I want to take with you. Mr. A holds 1,000 shares in ABC Limited, which is again an unlisted company, which were acquired in previous year 1, 2 at cost of rupees 75,000. He has been offered rights issue in August 24 at rupees 160 per share in the ratio of 2:5. He retains 50% of the rights share and renounces the balance 50% in favor of Mr. Lee for rupees 30 per share. In September 24, Mr. A sells all the shares in January 25 for rupees 300 per share, and Mr. D sells the shares exercised in December 24 at the rate of rupees 28 per share. So first we'll consider for Mr. A. So first for the 1,000 shares, what will be my capital gain? Yes. 1 minute time to you to tell me. Yes, students, faster. It's not that difficult. So for the 1,000 shares, if we start with, the full value of consideration will be what? My full value of consideration is 3 lakh, 1,000 into 300, right? Because I've sold at that particular price. Then what will be my cost of acquisition? Again, assuming no indexation at this moment, what is my cost of acquisition? $75,000. Yes, correct. So this is 2,25,000 is my long-term capital gain. Now coming to the 200 shares. So he has been offered the rights share in the ratio of 2:5. So how many rights share he would have got? Yes. How many rights share he would have got?
400 shares, ma'am.
400, right? Out of which 50% he has retained and 50% he has renounced in favor of D. So therefore, it means 200 shares is what we are talking about. Right? So 200, the FVC will be again how much? How much will be my FVC? Yes, faster. 200 into 300, which is 60,000. What will be my cost of acquisition? What will be my cost? Nil for renounce. So, Ginny, we are not talking about the shares renounced. Here at this moment, I'm talking about the shares which are sold. The rights share which I have subscribed, I have sold that. So, what will be the cost for that?
Actual price paid to the company, ma'am.
How much is that? Yes, how much is that? $160 into 200, right? It is 160 into 200 is the actual price which I have paid, right? 200 shares into 160. So 32,000 is what I have paid. Yes, correctly. So the long-term capital gain will be, or short-term, sorry, not long-term, 28,000. This will be my short-term because in the same year I'm selling it. Now, what about the shares, or sorry, rights renounced? Now, what will be my sale consideration for the rights renounced? I have renounced the rights in the favor of Mr. D for ₹30 per share. So 200 shares I have renounced and 30, which makes it to 60,000. What will be my cost of acquisition for the rights renounced? Yes, faster.
Ma'am, it's 6,000, ma'am.
No. How 6,000?
230 rupees.
Yeah, okay, that way. Okay. The FVC you are saying, right?
Yes, ma'am.
Yes. Sorry, it should be 6,000. Yes. Now what will be my cost? Yes, faster students. What shall be the cost? Nil. That's correct. So here the cost of acquisition shall be nil. So 60,000 shall be, sorry, 6,000 shall be my short-term capital. Now in the hands of Mr. D. What will be the capital gain in the hands of Mr. D? Yes. In the hands of Mr. D, how much is the sale consideration? So if you see, D has sold for the 28 rupees per share. So what will be my FVC for D? 28 into 200 he has purchased, right? Which is coming to 56,000. What will be the cost for D? Yes.
Ma'am, it is 5600.
Sorry, 5600. No, how 28 into 200? Yes, right. Now what will be my cost?
Ma'am, cost will be 6000.
6,000. How?
As he has been paid for the right issues to Mr. A.
So how much it will be? He has
Uh,
paid 30 to Mr. A plus 160 to the company,
yes, ma'am.
right?
Yes,
So
ma'am.
200. So this will be 190 into 200 shares. So this comes to 38,000. Are we clear? So he has sold for rupees 28 per share, but his cost of acquisition will be this. Are we clear? Yes or no? Any question? Any doubt so far? Yes? Are we clear? So this will result in short-term capital loss. Clear? Any questions so far? Any doubts? Yes? All of you clear? Okay. Now, let's proceed further to the ESOPs taxation. Now tell me, first of all, what are these ESOPs? What are the ESOPs? What you have understood by the term ESOPs? To whom it is granted?
Ma'am,
Ma'am,
Yes, one by one you can go ahead and tell me. Yes, please go ahead. What are ESOPs?
hello, ma'am. Hello. Hear me?
Yes, yes.
Ma'am, option representing a right, ma'am. The right, these rights are being provided by the company to its employees, officers for purchase of its own shares at a future date at a predetermined rate, ma'am.
Yes. So basically, see students, ESOPs are nothing but the company grants these stocks to the employees as a part of their compensation for the specific reason that they want to incentivize the employees. So they want to give the remuneration to the employees in the form of ownership in the company. So the company is granting these ESOPs to the employees, and these ESOPs are nothing but the appreciation or a form of appreciation to the employees. Now ESOPs is a way in which the stocks are issued to the employees or granted to the employees, may be based on them fulfilling certain conditions, sometimes without any conditions, and the employees have then a right basically to purchase these stocks after a vesting period at a predetermined price. Are we getting that? So let's say, for example, I am giving the ESOPs to my employee. Let's say I will ask him, let's say I'm giving you 100 ESOPs. I will ask him that you can purchase after a vesting period for, let's say, rupees 150. When the price in the market would be, let's say, 200 or 250. So this is how the ESOPs are granted. Are we clear? Now ESOPs is one. the company can also give them the RSUs. What are RSUs? Any idea? What are RSUs? Any idea? Recognized stock units. Any idea about that? So a company can give these stock options to the employees in three ways. One is through the ESOPs. Second is the ESPP, which is Employee Stock Purchase Plan. And the third is RSU. Now, what is RSU? First thing. Yes. So RSUs are the recognized stock units which are granted to the employees free of cost. Which are granted to the employees free of cost. So without the employees paying any cost to the company, the RSUs are granted. It's a recognized stock unit which is granted to the employees free of cost at zero purchase price. They will not pay any price to the company. Whereas under the ESOPs or ESPP, there is a price which is charged. Now, what is the difference between ESPP and ESOP? So, ESPP is where you have an option to purchase these stocks at a discounted price. Are we getting it? So under the ESPP, you have an option to purchase these stocks at a discounted price. Whereas under the ESOPs, you have these stock options granted to you at a predetermined price. So there is a difference between the ESOP, ESPP and RSU. So some companies give these RSUs, some company give the ESOP, some company give the ESPP. Yes. Now, how will the taxability of these work? That's what we have to understand. So when I'm just using an umbrella term over here, which is the ESOPs. So when these ESOPs are granted to the taxpayer, at that time there is no taxation. It's just that they are granted. Do you know any difference between the grant, vesting, and the exercise of ESOPs? Any idea about it? Any idea about the ESOPs grant, ESOPs vesting, and ESOPs exercise?
Ma'am, in ESOP grant, when the company offer shares to the employees, that process is called as ESOP grant, and the ESOP vesting period is a waiting period, just like when the company says to the employees that we are granting to you this much of shares and you can get exercise these shares after 1 year or after 2 years. Then this waiting period time is called ESOP vesting period of time. And when the this period is completed, and whenever the employees get exercise these shares, and this date is called exercise time or exercise date.
Yeah. So basically, grant means that the company is giving the ESOPs to the employees. Now, when the ESOPs are given by the companies, it may not necessarily vest with them also. Because the vesting period which is there is basically the period during which if you work for the company, then only the ESOPs will be available to you. So at the grant stage, an offer is made by the company. But under the vesting stage, there are conditions. If you do not fulfill those conditions under the vesting period, then the ESOPs may not be exercisable by you. So basically, these are the three stages. So at the grant stage, there's only a kind of agreement between the employer and the employee to give them an option to purchase the shares of the company at a future date. Only if the employee has fulfilled certain conditions which are there under the vesting period. And if it fulfills the condition, then only the ESOPs will be vested, and then only the right to receive will be established. Now, whether you think about it and tell me whether at the grant stage, according to you, should there be some taxability? Yes. Do you think there should be some taxability at the grant stage? Answer is no. Because at that point in time, you are not given any ESOP as such. All that is given to you is just an offer is made to you. Just an offer is made to you that you can purchase these shares, or these shares will be allotted to you at a future date. Now, see, the taxability can only happen when the income has accrued to you. When the income has accrued to you, only then the taxability can happen. Has the income accrued to me in the grant stage? The answer is no. Because can I sue the company if the company does not give me ESOPs? Answer is no. Because that depends on my vesting period. It's just a company has given an offer to me. So the income has not accrued at the grant stage. Are we getting that? Now come to the vesting period. Under the vesting period, it's only a window which is available to me to, give or perform my conditions. And then comes the allotment date or the exercise date. There, the taxability will arise. Now, how the taxability will happen? So, when you exercise the ESOPs, when the ESOPs are exercised, at that stage, there will be a taxability under the head salaries. So this income chargeable why the income is chargeable under the head salaries? Why on the exercise of ESOPs I am being taxed? What do you think could be the reason? Yes.
Ma'am, under the head salaries, because the company is given to its employee only, and this employee-employer relationship will incur this taxable charge under salaries head.
Absolutely. So see, the company is, when it is giving me the ESOPs or when it is allotting me ESOPs, this is part of my employment compensation package. So instead of the company giving me the salary in cash, it is giving me ESOPs. It is giving me these stocks at a discounted rate, at a predetermined price. So it is nothing but the salary in kind, isn't it? And salary in kind, what is known under Income Tax Act? Salary in kind, what it is known under Income Tax Act?
Perquisites.
Yes, absolutely. So this is nothing but taxable as a perquisite. Perquisites are taxable under which section? Under section 17 of the Income Tax Act. So this is nothing but my perquisite under section 17 to 6 of the Act. Are we clear? And this will be taxable in the previous year in which the ESOPs are exercised. So this is going to be taxable in the previous year in which ESOPs are exercised. And what will be my taxability? So what will be my perquisite here? So logically, students, my perquisite is FMV as on the date of exercise minus the exercise price. Because what I am paying to the company, that is something which is not salary, which is what I'm paying to company. But what is my perquisite? My perquisite value which is there is nothing but the discount at which the company is allotting me the ESOPs. So what is the discount? Discount is the FMV as on the date of exercise minus the exercise price. Right? Very logical. So perquisite is FMV as on the date of exercise minus the exercise price. Now what is the FMV? It is given under the rules how to determine the FMV. So for the listed stocks on the recognized stock exchange, the FMV is nothing but the average of the opening and the closing prices of the stocks. So average of the opening and closing stock price in the recognized stock exchange, that is what my FMV will be. If, let's say, for example, the stock is listed on more than one recognized stock exchange. Let's say BSE पे भी listed है, NSE पे भी listed है. So then what will be my FMV? FMV will be the average of the opening and the closing price at the stock exchange where the highest trading is done. And if it's an unlisted share, then it is going to be the value of the merchant banker. Then as per the valuation report from the merchant banker. Yes, is this clear now? Yes or no? Now, when the ESOPs are exercised, this is what my perquisite will be. Now, you will ask me then, ma'am, why are you teaching this in capital gain? This should be taught as a part of the salary chapter. Why under the capital gain? Because, let's say, for example, when these ESOPs are sold, at that point in time, what will be my cost of acquisition? What will be my cost of acquisition? Yes. What will be my cost of acquisition?
Exercise price.
No, it is not the exercise price. What is it? It is not the exercise price. It is this FMB, which I have paid the tax year on. This will be my cost of acquisition. This is known as a step-up cost. Step-up cost meaning that something on which the taxability has already happened, that is now allowed to me as the cost so that there is no double taxation. If I will consider FMB, if I will consider the exercise price, what will happen? I will have to pay tax on the difference between the sale price minus the exercise price as capital gain. At the same time, FMV minus exercise price I am also charging to salary. So there is a double taxation under the two heads of income. So here I will allow under the capital gain the FMV as on the date of exercise. Are we clear about this? Yes or no? Any questions so far? Any doubt with respect to the ESOP? Yes? Are we clear? Okay. Any question? Somebody has question? No? Okay. So let's proceed towards the next instrument that we are going to talk about, which is a market-linked debenture. Yes. Now, let us try and understand. This is very, very important, students, for your attempt, because this has undergone some amount of changes. Okay. So let us try and understand this particularly. Now, there is a specific taxability of this. There is a specific taxability of this under section 50AA of the Act for the market-linked debentures. And what are these? We'll try and understand in a specific manner. So under the Act, in 2023, this particular special provision was introduced for computation of capital gain in the case of market-linked debenture under section 50AA of the Act. Are we getting this? So, what is it exactly? Let's try and understand. So, 50AA section provides that Section 50AA provides that in respect of the market-linked debentures, the taxability shall be only through the way of this specific section, which is 50AA, which provides that in case of transfer or redemption or maturity of number one, a unit of the specified mutual fund. We will see what is a specified mutual fund. On or after 1/4/23. B. Market linked debenture. And number C, unlisted bond or unlisted debentures, which are transferred or redeemed or matured after 23rd of July 2024. Are we clear? Then the taxability will happen under section 50AA. Now 50AA is notwithstanding anything contained in two sections. Section 242A or section 48. What is 242A, students? What is
Yeah,
section
holding.
242A? Yes. What was 242A? Yes, you have forgotten the section number. Yes, what is it?
242A is related to period of holding.
Correct. Period of holding. So, section 50AA is overriding the period of holding. Why is it overriding the period of holding? Because it is saying that any capital gain which is arising on the specified mutual funds, on the market-linked debentures, or on the unlisted bond or unlisted debentures shall be the short-term capital gain. Shall be deemed to be the short-term capital gain. So that is the reason why the period of holding under 242A is not going to be applicable to 50AA. So 50AA starts with the clause notwithstanding anything under section 242A. Number 1 point. What is section 48 about? What is section 48?
Mode of computation.
Mode of computation. It is also overriding section 48, meaning it is giving its own mechanism to compute. That means it is not allowing me any indexation or any deductions which are available under 40. So that is the reason why it is trying to override these two sections. Are we clear? So capital gain arising from the transfer of or redemption of or maturity of unit of specified mutual fund or market linked debenture or the unlisted bond or unlisted debenture would be deemed to be short-term capital gain, irrespective of my actual period of holding. Are we clear? However, for the computation, it says that the computation will be from the full value of consideration. You will reduce the cost of acquisition and the expenditure on transfer. So the computation more or less remains the same. So my capital gain here shall be FPC minus the cost of acquisition minus any expenses on the transfer. Now first we have to understand what are the market-linked debentures. Here it is not difficult to understand the section per se. But what are the market-linked debenture and what are the specified mutual fund? See, until last year, the definition of the specified mutual fund was very different. Are we clear? So until last year, until 2023, the definition of the specified mutual fund was that a mutual fund where we invest more than, or mutual fund which invests more than 65% of its proceeds in debt and money market instruments, or a fund which invests 65% or more of its total proceeds in the units of another mutual funds who then invest in the money and the debt market instrument. Now this year they have changed the definition. So this year onwards, they have changed the definition of the specified mutual fund. Now what is the definition of the specified mutual fund? So now they have said it, if a mutual fund invests not more than 35% of its total proceeds. If the fund invests not more than 35% of its total proceeds in the equity shares of domestic company. Now, what is the difference? See, until 2023, you don't have to remember for 2023. So until 2023, I'm just trying to bring a difference. It was said that a fund which invests 65% of its proceeds in the debt and money market instrument will be called as a debt-oriented fund and will be covered by 50AA. Because if you see in the line of 50AA, it is talking about a specified mutual fund, market-linked debenture, or unlisted bond or unlisted debenture. So they're more talking about the debt-oriented funds. So the specified mutual fund in the last year, till last year, it was defined as a fund which is investing more than 65% of the proceeds, of the total proceeds it is collecting from the unit holders into the debt and money market instruments. Now they have said nothing like that. They have said all the mutual funds where they do not have the investment more than 35% in the equity shares of the domestic company. They have just reversed the scenario. If you see technically, they are trying to change the order. First, there was a positive definition saying that a fund which invests more than 65% in debt. Now they are saying it should be a fund which is not investing more than 35% in the equity shares. Then it's a debt-oriented fund. If you invest more than 35% in the equity shares, then you are not covered by 50AA. So a specified mutual fund, you can write down here, will be a mutual fund where less than 35% of total proceeds are invested in equity shares of domestic company. Less than 35%. Are we clear? Any doubt so far? Yes. Any question up till the specified mutual fund? Yes or no? Any questions so far with respect to the specified mutual fund? No? Okay. Now, what is a market-linked debenture? So, market-linked debentures are the securities where the underlying principal component is a debt security, but the returns are linked to the market returns. Where the returns are linked to the market returns. So, this is something, as the name you will see suggests. Here, the underlying security of this debenture is nothing but the debt. Is a debenture. But the returns are not, like some 10% interest, 5% interest, and the debentures, if you see, the returns are more or less fixed. Normally, in the debentures, if you see there are 10% debentures, 15% debentures with a fixed coupon rate. But market-linked debentures are not the fixed return debentures, although their underlying principle is in the form of the debentures. However, here the returns which are there are linked to some indices, are linked to basically the market. So there are many companies which are raising the funds through the market-linked debenture, where it will be a debenture, but the return will be there. The return which is paid to the holders is basically dependent on the how a particular index is performing, maybe. So it's a debt security, but the returns will be based on some other instrument which is listed in the market. So that is also covered over here. So maybe it is based on Nifty, maybe it is based on Sensex. So it works like that. So let's say, for example, there is a market linked debenture, I'll call it as MLD. The return on the MLD is, let's say, 10%. Based on or subject to the condition that the value of the NSE Nifty at the end of, let's say, 15 months does not fall below 75% of its current value. So it is dependent on the market. So the return is fixed in a way. But I will give you this fixed return provided the value of NSE does not fall below the 75% of its current value. If it falls below the 75%, I will not give you this return. But if it is more than 75% of its value, I will give you, let's say, a 10% return. Are we clear? Yes or no? So, and then third is the unlisted bonds or unlisted debentures which are covered over here. Yes or no? Any questions so far? So, in these cases, it will be deemed to be the short-term capital gain. Yes? Any question, any doubt? Yes or no? Yes? Can you have a look at it for 1 minute and let me know if it is looking fine to you? Yes. Just go through it for a minute and do let me, okay. Okay, 1 second, you can just change here. I think this should be. Here you can just correct this. So I've written the old provision for you, sorry. Here it should be, the new provision is, you can write down, this was before amendment. So after amendment, it says a mutual fund which invests greater than 65% in which invests greater than 65% in the or 65% of the total proceeds in the debt and money market instruments. See, that was before amendment. We have mixed it. And B, a mutual fund which invests greater than 65% or greater than equal to 65% of total proceeds in the unit of another mutual fund, who will then greater than equal to 65% in debt or money market instrument. Okay. Are we clear? So before the amendment, it was less than 35% in the equity, and after the amendment, it is more than 65% in the debt and money market instrument. So I have said it in the reverse order earlier, but after the amendment is this provision, and before the amendment was less than 35%. Yes, are we clear? Any doubt, any question? For the market link debenture, you can just write the meaning in a very shorter way or in a brief manner. Market link debentures are basically, you can write the debentures where the underlying security is debt, underlying security is my debt, but returns are linked to market. The returns are linked to the market. Are we clear? Yes or no? Any doubt, any question so far, students? Where the market link debentures gives fixed interest to holders or not? It will give a fixed interest, but the return is going to be linked to the market. Let's say I promise you 10%, but 10% will be given to you only when, let's say, Nifty will cross 50,000 mark. Or let's say when the Nifty will be at the 50% of its current value. So that is how it is linked to the market. Clear, Jenny? Yes, on the condition basis. Absolutely. Any other question, any other doubt so far? Yes or no? Okay. Fine.
Ma'am,
Yes.
mark debenture is at fixed rate of interest. Then how can we say ki if market is upside, then our interest rate will be up, and if down, then our interest rate will be down?
No. It will not say like that. What it will say is, we will pay you this interest provided the market is performing in this manner. So it is a conditional interest which is given. The percentage may be fixed, but it will give you the interest only on the satisfaction of the condition, of a particular condition. Without the satisfaction of condition, you may not get the interest also. Are we clear?
Okay, ma'am.
Okay. Any other question?
Ma'am, the definition of specified mutual fund you have given. The first one is the mutual fund itself investing 65% of more than 65% proceeds in the debt and money market instrument.
Correct.
And in the second one, the mutual fund invest to another mutual fund.
Correct. Yes. So not necessarily mutual funds are always investing directly. They can have the investment in another mutual fund who is then, investing in the debt or money market instrument.
Then ma'am, the first mutual fund will give instruction to the second one that the 65% you should.
No. They will not give instruction. They will just invest, and we'll see what is the underlying investment of the second mutual fund.
Okay.
So let's say you will have investment in another mutual fund of more than 65%, but that another mutual fund should not be then investing in equity. It should be investing more than 65% of its own fund into debt or money market instrument. Clear?
Its own fund meaning, ma'am?
The funds that it is collecting from the unit holders.
Okay, ma'am.
Yeah.
Okay, clear, ma'am. Thank you.
Okay. Yes. Now there is a difference between a debt-oriented fund, which is a specified fund that we have spoken about, which is investing more than 65% of its total proceeds in debt or money market instrument. And then there is equity-oriented fund. See, this specified mutual fund which is there, which is investing more than 65% of its proceeds in the debt or money market instrument, is a specified mutual fund, which is the gain on which will be deemed to be a short-term capital gain. Whereas, where a mutual fund is there, which is investing on the units of that particular fund, which are there, where the proceeds are collected from the investors. So in that case, a minimum of 65% of the total proceeds in the case where are invested in the equity shares of the domestic company. Here we are talking about the specified mutual fund where 65% of its proceeds are going into the debt or money market instrument. But where the 65% of my proceeds are invested in the equity shares of the domestic companies which are listed on recognized stock exchange. So basically where 65% of my proceeds are invested in listed equity shares, then it will be a equity oriented fund. Are we getting that? So it will be then an equity oriented fund. So what is an equity oriented fund? I'm just drawing a distinction over here for you. So equity oriented mutual fund. Number one, where it invests greater than equal to 65% of total proceeds in listed equity shares. Secondly, where a mutual fund invests in another mutual fund. Which is listed on a recognized stock exchange. So one mutual fund investing in another mutual fund which is listed on a recognized stock exchange. How many funds? Minimum of 90% of the proceeds. And the listed mutual fund invest 65% of total proceeds in listed equity shares. So see what is happening? It is, opposite of debt. Under the specified mutual fund, you are investing 65% in the debt or money market instrument. Whereas under the equity oriented fund, you are investing more than 65% of total proceeds in listed equity shares. Or you are investing in another mutual fund which is listed on a recognized stock exchange, you are investing 90% of your proceeds into that fund which is listed on a recognized stock exchange, and then that fund which is listed on a recognized stock exchange will invest 65% of proceeds in the listed equity shares. Similar to how we understood the definition of specified mutual fund. It's completely opposite of that. So then it will be an equity oriented fund. Now what will happen if it's an equity oriented fund? For equity oriented fund, 112A is applicable. 112A is applicable, which is 10% tax, 12.5% tax rate. Isn't it? So 112A will become applicable over here. Whereas here, 112 will be applicable. In case of a long-term, in case of the short-term capital gain, which is there, here we have the 112A becoming applicable. In case of the long-term capital gain, it will be 112A, which will be becoming applicable. So here not 112A for sure. It's deemed to be the short-term capital gain. Yeah. It will be taxed at a normal rate. Are we getting this point? So for the equity-oriented mutual fund, your period of holding is also 12 months. Here, in the specified mutual fund, your period of holding we just completely ignore because it is deemed to be the short-term capital gain. And the tax rate will also be a normal tax rate which will become applicable. Whereas under the equity-oriented fund, if it's a long-term capital gain, you will have 112A. If it's a short-term capital gain, there will be 111A. And the period of holding will be 12 months. Are you understanding the difference between the debt-oriented and equity-oriented mutual fund? Yes or no? Any questions? Any doubts so far?
Ma'am, please once again repeat the 111A explanation.
Yes. So if it's a short-term capital gain, it will be 111A. If it's a long-term capital gain, it will be 112A. We will go and study what is 112A tax rate, what is 111A tax rate, that is there. But it's a special tax rate which is applicable for listed equity-oriented funds. Are we clear?
Yes, ma'am, clear.
Yeah, okay. And the period of holding will be 12 months. Okay. Whereas for the specified mutual fund, it will be deemed to be a short-term capital gain. So under 50AA, just to recap everything, 50AA will cover a specified mutual fund. What's a specified mutual fund? Which invests more than 65% of the funds in the debt or money market instrument or into another fund. 65% of its proceeds in another fund, which will then invest into the debt or money market instrument. Then market-linked debentures and the unlisted bond or unlisted debenture transferred, redeemed or matured on or after 23rd of July. Before 23rd of July, these were not covered under the 50AA. It was to be taxed as per the long-term, short-term period of holding, which was earlier 36 months. So this is only applicable, 50AA is only applicable on the unlisted bond or debentures after 23rd July. Market-linked debenture, specified mutual funds, it is even there, they were even there before 23rd July. But for the unlisted bonds or unlisted debentures, only covered after 23rd of July 2024. If they are redeemed after 23rd July 2024. Are we getting that? So in that particular case, you will be considering the transfer, redemption or maturity as deemed to be the short-term capital gain. Are we clear? If your unlisted bond, unlisted debentures are transferred, redeemed or matured before 23rd July 2024, then it will not be covered by 50AA. Remember that. Then it will not be covered by 50AA. Then earlier, how you used to tax it as per its period of holding, you will tax in the similar basis. This is only applicable on the unlisted debentures or the unlisted bonds after 23rd of July. Remember that. Are we clear? Yes or no? And if it's equity oriented fund, which is investing more than 90%, or sorry, more than 65% in the equity shares, or into another fund which is listed equity oriented fund, then it will be called as equity oriented. Clear? And then the taxation will be in the 111A or
Excuse me,
112A. Yeah.
Ma'am, please clear B point again. In equity
Sorry?
oriented, in
Sorry, sorry.
equity oriented mutual fund, please clear B point again.
Yeah. So the B point is where I am investing, I am a mutual fund. I am investing in another mutual fund, which is a listed mutual fund on the recognized stock exchange, 90% of my total proceeds. And that listed mutual fund is investing 65% of proceeds in the listed equity shares. Then also I'll be called as equity oriented fund. So basically, let's say for example, this is fund A. This is fund A. This is investing in, let's say, fund B, 90% of proceeds. And this fund B is investing 65% in the equity shares, which are listed. So then this fund A will be an equity oriented fund.
Okay,
Are
clear,
we clear?
ma'am. Yes,
Yeah.
ma'am, very much clear.
Okay. Yes or no, students? Any question, any doubt?
Ma'am,
Yes.
it means in both the cases, even if a specified mutual fund and this equity oriented fund, the first mutual fund is already known now that B is going to invest 65% of its mutual fund in debt instrument or equity instrument.
Yeah, they mostly know because the data is available that what is the, bucket of the other fund.
Okay.
Yeah. You can just write one point over here. For the unlisted bonds or the debentures transferred before 23rd July 24, my period of holding in that case will be 36 months. Are we clear? Are we clear? Any question, any doubt? Yes or no? Okay. Yes. So let's take a break of 10 minutes and then we get back. Okay. Let's take a break of 10 minutes. Done with then the second part of our lecture, which is what I was discussing, the capital gain arising on the transfer of different instruments. Okay. Now I'm coming to the third important part, which is reorganization. But before I get into that, let me touch upon the period of holding, which has undergone change since this particular year or from this particular year. Now, period of holding, which section it was? Yes. Which was the section of our period of holding? (242A), right? 242A is the section for the period of holding. Now, earlier, there used to be, or in the IPCC also you would have studied, there used to be 3 period of holding. Which were those? You would have learned something, right? So please answer me. What were the period of holding that you have studied so far? 12 months, 24 months, 36 months, isn't it? So
12
these are the,
months.
yes, please go ahead. Yes,
12 months.
12, 24, 36. This is what it used to be till now, isn't it? But now onwards, you have only 2 period of holding, which is 12 and 24 months. They have done away with the concept of 36 months period of holding. However, students, that doesn't mean that you don't have to remember कि 36 months भी करके कुछ था अभी तक. No, because the amendment has taken effect from 23rd of July 2024. The amendment will take effect from 23rd July 2024. Which means what? Which means what? That till 23rd July 2024, we have 3 period of holding. Number 1, 12 months. Number 2, 24 months. Number 3, 36 months. Yes, Mihika. And then post 23rd July 2024, we have 12 and 24 months. So, the 12-month period which was there was applicable to which class of assets? Yes, students, please faster. Which class of assets did we have covered? Yes.
Ma'am, for equity shares,
For
we
equity shares. Yes.
will consider 12 months period of holding.
Correct. So, section 242A provided that the short-term capital asset, in case of a capital asset held by an assessee for not more than 36 months preceding the date of transfer. So, 242A doesn't say ki, this is the period of holding. 242A defines the meaning of a short-term capital asset. And 229A defines what is the meaning of long-term capital asset. Long-term capital asset is nothing but the asset which is not a short-term capital asset. So, 242A says that short-term capital asset is which is held by an assessee for less than or equal to 36 months. It was prior to 23rd July. And then it says the provisos to that says that in case of a share or in case of a share which is listed on or security listed in a recognized stock exchange in India. Doesn't use the word share, it says security. So in case of listed security, secondly, units of UTI, Unit Trust of India, and third, units of equity oriented fund. The period of holding was considered as 12 months. In case of listed security, in case of UTI, units or unit of equity oriented fund, and zero coupon bond. And zero coupon bond will be till 23rd July 2024. The period of holding is considered as 12 months. But here also there is one amendment which is specifically made, which I want to highlight to you. What is that amendment? See, till 23rd July 2024, they used to say listed securities other than unit. They used to say listed securities other than the unit. But post 23rd July 2024, they have deleted this particular word other than unit. So that means post 23rd July 2024, listed securities, including listed units, will be covered for 12 months. So, 242A, which is defining a short-term capital asset, it is saying if it is, you can just write like this. Instead of just 12 months, you can write less than equal to 12 months. It's a short term. If it is more than 12 months, it's long term. In case of post 23rd July, the period of holding remains the same, which is less than equal to 12 months. However, one more change which has happened here is even the listed securities, in the listed securities, earlier it was other than unit, but now it will cover securities listed in recognized stock exchange, including listed units. So here the coverage will be listed securities, listed units, units of UTI, units of equity oriented fund, and listed units of business trust. So earlier, units of business trust, units of REIT, which used to be listed on a recognized stock exchange, these used to have a period of holding of 36 months and not 12 months. But now, listed units of business trust will now have a period of 12 months because the word or the term other than unit has been deleted. Are we clear, students? So, अगर एग्जाम में क्वेश्चन आता है, you have to be careful where the dates I am using are pre-23rd July and post-23rd July 2024. So by this way, you will not make a mistake. And remember this thing, students, you can easily get a question in the examination around this point where the assets are purchased prior to 23rd July and sold prior to 23rd July, and some assets being sold after 23rd July. Yes, are we clear? So you can just write it if you want a separate point. Here, listed debentures. Earlier, it used to be 36 months. Now it is 12 months. Are we clear? Even listed units of business trust it used to be 36 months and now it is 12 months. Then, in case of immovable property, it used to be 24 months. In case of immovable property, it used to be 24 months. Even now, it is 24 months. Even now, it is 24 months. Clear? Then, in case of unlisted equity shares, earlier it used to be less than equal to 24 months. Even now it is less than equal to 24 months. Clear? In case of gold, it used to be earlier 36 months, but now it is 24 months. Because gold was falling under any other asset, so it used to be 36 earlier. But now the maximum period of holding is they have reduced to 24 months. Then, in case of unlisted debentures or unlisted debt, debentures, unlisted debt or debentures, for them it used to be earlier less than equal to 36 months, but now it is deemed to be short-term capital gain under section 50AA. It is deemed to be a short-term capital gain under 50AA, right? Just now we studied. Last point. In case of slump sale, which is what we are going to study. In case of slump sale, it used to be 36 months and it is still 36 months because this is provided under section 50B, which has not changed. The period of holding for slump sale is not given under 242A. It is given under 50B, so it has remained the same. So only for the slump sale, you have a period of holding of 36 months. Rest for all the other assets, your period of holding maximum will now be 24 months. So just a quick recap with all of you. Listed equity shares, what was period of holding? Yes. Listed equity share, what was the period of holding prior to 23rd July?
12.
12, right? And now what it is?
12 months.
Yes, 12 months. Listed units of business trust, what it used to be? Units of business trust?
36 months.
Yes. All of you please together, you can all put on your mics. I don't have a problem with that. 36 months. And now what it is?
12 months.
Correct. Now it is 12 months because other than unit word is deleted post 23rd July 2024. This date is very important for capital gain class. 23rd July 2024. We'll come back to this date in the next class when we will go to the computation also. Right? Then listed units of equity oriented fund. It used to be 12. It is now 12. Zero coupon bond 12 and 12. Right? Then in case of unlisted shares, what was it? Unlisted? Yes. Faster unlisted shares.
24 months.
24 and now also it is 24.
24.
Yes. Then in case of immovable property, 24 था, अभी भी 24 है. In case of unlisted debentures or unlisted debt, what was the time period?
6 months.
36 months, not 6, 36 months. And now what it is going to be?
54 months.
How much? 54?
50 AA section deemed.
Yes, it will be deemed to be a short-term capital gain as per section 50 AA, irrespective of my period of holding. In terms of gold or in terms of any other asset, what was the period of holding earlier?
36 months.
36 months. And now it will be
24.
24 months. Slump sale, 36 months was there and it will remain 36 months. What about a depreciable assets? What is the period of depreciable asset?
Earlier it was 36 months.
No.
No, always short-term capital gains.
4
Yes.
months.
Yes. No 24, no 36. It used to be a short-term capital gain under section 50A of the Income Tax Act. The capital gain on the sale of a depreciable asset is deemed to be a short-term capital gain. And even now it stands the same. So in respect of depreciable assets, there is no difference between then and now. It is always deemed to be a short-term capital gain irrespective of the period of holding. So here period of holding does not matter in case of depreciable asset. Are we clear about this? Any question in respect of period of holding? Yes or no?
Well, depreciable assets, for example, you can say machinery,
Yes.
and it is for a long period.
Yeah, that is fine. But in respect of depreciable asset, if you remember in the earlier class, we had seen that in respect of depreciable asset, the capital gain will deem to be a short-term capital gain. Irrespective of the period of holding, section 50 says that when the capital gain will be realized when the sale consideration is greater than WDV, or the entire block is ceased to exist. Then in that case, the gain will be deemed to be from the short-term capital asset, irrespective of the period of holding. Are we clear?
Oh, ma'am, your voice was just.
Okay. So I am saying that in respect of the depreciable asset, section 50 says that irrespective of my period of holding, the gain would be deemed to be a short-term capital gain. Are we clear?
Yes, ma'am.
Okay. Any other doubt? Any other question in respect of period of holding before we move further? Okay.
Ma'am,
Yes.
in this the listed unit which is included in after 23/7, it will it is debenture units, na?
Units of REIT, business trust.
Okay.
Yeah.
Then, ma'am, earlier in the list, you have written in B point listed units and E points listed units of business trust. Any?
Yeah. So I've just tried to clarify it. See, listed units of business trust. Here also I have written because the word other than unit is deleted. So in the red also I have written there post 23rd July. And again I have just written for the sake of clarity that listed unit of business trust earlier used to be 36 months. So that I can give you that prior to 23rd July, if the question comes, you have to use 36 months. And post 23rd July, it will be 12 months.
ओके, यानी मुझे ऐसा लगा कि दोनों अलग अलग पॉइंट में दिए
No,
हुए
no,
हैं,
no.
ये
It's the
दोनों
same.
अलग है.
Yeah, it's the same. I just wanted to, bring that clarity to you.
Okay, ma'am, clear.
Okay, any other questions, students, before we move further? Okay, fine. Now we move to the reorganization part. Now understand, when practically we do mergers and acquisitions, these 5 to 6 sections is what we focus on. In the real life, if you are into the field of M&A, the tax part mostly will be concerning this capital gain chapter. But around that also, these 5 to 6 sections is something that we will look at. So if you're somebody who is interested in M&A, you should be very well thorough with these particular sections. So the first section that I'm going to talk about is transfer of capital asset by a holding company to a wholly owned subsidiary and vice versa. Okay. So transfer of capital asset to a wholly owned subsidiary by the holding company and vice versa situation. So let's say there is a holding company. This is transferring the capital asset to a wholly owned subsidiary. Now the condition is that this should be a wholly owned subsidiary, meaning 100% stake into this. And this should be an Indian company. So not only this should be a wholly owned subsidiary, but this should also be an Indian company. Now, if the asset is transferred by a holding company to a wholly owned subsidiary, this will not be regarded as transfer under section 47. So transfer of asset by a holding company to a wholly owned subsidiary is not regarded as transfer under section 47(4) of the Income Tax Act. This is exempt. Similarly, if the wholly owned subsidiary is transferring the capital asset to the holding company, it will not be regarded as transfer under section 47(5) of the Income Tax Act. Here also the condition is similar, that it should be a holding company. Sorry, it should be a wholly owned subsidiary, but the holding company here should be the Indian company. So it is always the recipient company should be the Indian company. Either it could be wholly owned subsidiary or it could be holding company, but the recipient company should be an Indian company. So when the holding company or the wholly owned subsidiary transfers the capital asset, could be any capital asset, but it should be a capital asset, to a wholly owned subsidiary, or wholly owned subsidiary transfers to the parent company. In either case, the recipient company should be an Indian company. This will not be regarded as transfer under section 47(4) and section 47(5) of the Income Tax Act. What about the recipient company which is receiving the capital asset? So a company which is receiving the capital asset, so technically if you remember in IPCC you would have done one section 56 to 10. What is 56 to 10? Anybody who knows that?
Gift.
When it is applicable? When is gift applicable? Gift tax applicable? Yes?
Value about 50,000, ma'am.
Yes. So where if you receive a capital asset, either without any consideration or for inadequate consideration, and that FMV is more than rupees 50,000, then in that case, in the hands of the recipient, the value of that asset, if you receive without any consideration, is charged to tax under section 56 to 10 of the Income Tax Act. In the IFOS class, we will learn about that. But for now, you remember this. If you receive a capital asset without any consideration in the hands of the recipient, if the value of that asset is more than 50,000, you will be charged to tax the under section 56 to 10 the value of that asset you receive. However, 56 to 10 is also not applicable in this case, because under that also there is a specific exemption, that if the transfer is by a holding company to a wholly owned subsidiary or wholly owned subsidiary to holding company, 56 to 10 will not be applicable. Are we clear? So 56 to 10 is not going to be applicable in this situation, provided if the recipient is the Indian So see, you have to link these two sections in the real life also, in the exam also. The question will be a combined question. It will not be only testing what will be capital gain. It will test all the tax implications. So the way you are learning the exam will not be that way. The exam will be a full-fledged question. And there you have to link the two provisions and write that yes, this will not be regarded as transfer in the hands of the transferor. In the hands of the recipient, 56 to 10 will not be applicable. So this is in fact a tax-free transfer of a capital asset. Are we clear? But here, remember one thing, students. Here there are two conditions to be satisfied. Here you need to satisfy two conditions. First is the primary condition. What are the primary conditions? That the subsidiary company should be a wholly owned subsidiary plus the recipient company should be what? Should be what? Yes, should be what? Recipient company should be what?
Indian company.
Indian company.
Indian company. So this is my primary condition. Plus, there are certain additional conditions. What are the additional conditions? Number one, the recipient company shall not convert the capital asset into the stock in trade. Recipient company shall not convert the capital asset into the stock in trade. Are we clear? Second, these are all the cumulative conditions. And the subsidiary company should not cease to be a wholly owned subsidiary. Are we clear? So, a recipient company should not convert the capital asset into stock in trade, and the subsidiary company should not be cease to be a wholly owned subsidiary company. Are we getting this point? So these are my two additional conditions beyond the primary conditions that I have. Are we clear or not up till this point? Fine. Now these which are conditions which are there. These conditions which are there. That the subsidiary should not, also the recipient should not convert the capital asset into stock in trade. And the subsidiary company should not be ceased to be a wholly owned subsidiary. These conditions are for the period of 8 years from the date of transfer. These conditions are only up till the 8 years from the date of transfer. If you violate any of the additional conditions, then the exemption shall be withdrawn. So where before the 8 years from the date of transfer of capital asset on which you have claimed the exemption under 47(4) and 47(y), if either you converted the capital asset into stock in trade or the subsidiary company ceased to be a wholly owned subsidiary. Let's say parent company sells 10% stake, 5% stake to some other party. then the exemption which was given under 47.4 and 47.5 will be withdrawn and will be deemed to be income under the head capital gain in the year in which the transfer takes place. So exemption, if you violate, so violation of any conditions, then exemption under section 47.4 and 5 is withdrawn. So therefore, what will be my implication? So capital gain exempted earlier deemed to be income of the transferor in the year of transfer. Are we clear? So capital gain exempted earlier shall be deemed to be the income of transferor in the year of transfer. Clear? There is no violation of the condition when the capital asset acquired is transferred. See, जो कैपिटल एसेट मैंने होल्डिंग कंपनी या सब्सिडरी कंपनी से अक्वायर किया है, if I sell that asset, there is no violation of condition. The violation of condition is only applicable in the case where the recipient company converts the capital asset into stock in trade, or the subsidiary company ceases to be a wholly owned subsidiary. Are we clear about this? Any question? Yes? Now, what if, let's say, for example, the capital asset transferred, by, let's say, the holding company to wholly owned subsidiary is sold by wholly owned subsidiary, or vice versa. Capital asset transferred by wholly owned subsidiary to holding company and then sold by the holding company. In that case, so जो मुझे capital asset मिला है मेरे holding company से, मैं अब उसका sale कर रही हूँ. So what will be the cost of acquisition of that capital asset? What will be my cost? So ये wholly owned subsidiary के हाथ में, what will be the cost of this capital asset? What will be the cost of this capital asset? Yes, Mihika, very correct. The cost to the previous owner. So here, my cost of acquisition will be the cost to the previous owner. Which section was this? Section 49.1. What will be the period of holding of this capital asset? What will be the period of holding of this capital asset? Yes, Mihika, correct. So the period of holding of the previous owner will also be clubbed as per which provision? Yes, students, as per which provision? You have to remember these sections. As per explanation 1 to section 242A. Yes, Mihika. So as per explanation 1 to section 242A. What about indexation? What about my indexation on that asset? Indexation from when? Yes. Indexation from when? From the year in which the wholly owned subsidiary received the asset, or from the year when the holding company purchased the asset? When will the indexation start? No, Vignesh, it will not be the actual purchase. Yes, you're right, I think. Yes. So year in which the asset was held by the previous owner, year of actual purchase. Yes, Vignesh. Yes, Mihika, correct. This is as per which provision? This is as per which provision? Yes, Mihika. Manjula Shah judgment. Absolutely. So this is as per Manjula Shah decision. Yes, students, are we clear up till this point? Yes or no? Yes? Any questions so far? Are we clear? I need yes or no in the chat boxes. All good? Others, please answer. If you have not understood, please let me know any point that you have not understood. But I want all of you to be very, very clear about this aspect. Because now we are proceeding further on this area. Yes or no? Clear? Yes, everybody clear? Okay. Let's proceed further. Okay? Prashant, I think you can also join from the Zoom link. Amit, you can also join from the Zoom link. It will be easier to take your questions as well. Okay? So, now we move further. Now, let's understand this particular aspect when the conditions are violated. So, let's say when the first condition is violated, which is a subsidiary company ceases to be wholly owned subsidiary. So what will happen? The capital gain exempted earlier, you said, will be deemed to be the income of transferor in the year of transfer. So it will be a backdated capital, right? So in the year in which the asset was transferred, in that year, the capital gain will be taxable as per section 45. Isn't it? But what will be my computation? What will be my computation? So here, the taxability will arise in the hands of the transferor, right? The taxability will be full value of consideration will be what? Because technically I have not got any consideration from the recipient. I have given the capital asset without any consideration. So there is no sale consideration involved. So FVC here we will take as FMV as on the date of transfer. Are we clear? Minus the cost of acquisition will be my actual cost. And the period of holding will be my actual period of holding. Are we clear? Yes or no? Any doubt up till this point? Clear? Yes or no? Any questions till this point? No? Okay. Now, in the next case, where the recipient company converts the capital asset into the stock in trade. So here, there will be two implications which will arise. One is, in the hands of the transferor, there will be capital gain, which will be again this particular thing only. FVC will be my FMV as on the date of transfer minus the cost of acquisition, and the period of holding will be my actual period of holding. There will also be implication in the hands of the recipient. Let me see who answers that. In the hands of the recipient company, there will also be implication. What will be that implication? Yes. Transferor के हाथ में तो there will be the normal capital gains which will be chargeable. But recipient के हाथ में there will be another implication which you have already studied so far. What will be that, students? Yes, Mihika, very good. Yes, Oja. Good, but an incomplete answer. I'm looking something very specific, Oja. Let me see who else answers. The second section that we had studied in the very first class. What was that? Conversion of capital assets into stock in trade. 45(2). In the hands of recipient company, 45(2) will get triggered. Yes. 45(2) says what? Taxability when the stock in trade is sold. My FVC is FMV as on the date of, yes, FVC is as on the date of conversion minus cost, which is my actual cost, and the period of holding is till the year of conversion, right? Even the indexation. And secondly, there will be PGBP, which will be my sale consideration minus the cost of acquisition, and the cost will be this FMV. So this will give me PGBP and capital. So this is in the hands of the recipient. In the hands of transferor, capital gain exempted earlier will be now charged to tax. In the hands of recipient, since he has converted the capital asset into stock in trade, the transfer gets triggered, 247 gets triggered, 45(2) will become applicable. Yes or no? Convert the transfer of capital assets to a wholly owned subsidiary or transfer of capital assets by a wholly owned subsidiary to holding company will be considered as exempt under 47(4), 47(5). Two conditions. The subsidiary should be wholly owned subsidiary. Recipient company should be Indian company. Two additional conditions. What are the additional conditions? Additional conditions are that the subsidiary company should not cease to be a wholly owned subsidiary. The subsidiary company, or sorry, the recipient company should not convert the capital asset into stock in trade. If the conditions are violated in the hands of the transferor, the capital gain exempted earlier will now be taxed. So full value of consideration will be FMV as on the date of transfer and minus the cost of acquisition and the period of holding on actuals. This will be taxable in the year when the transfer originally took place. Are we clear? So it will be a backdated period because the conversion of the capital asset into stock in trade might have happened during the 8-year window which is given, let's say in 3rd year, in the 4th year. But the taxability, the exemption which is given will be withdrawn in the year in which the transfer took place, maybe 2 years back. And in the hands of recipient, when the capital asset is converted into stock in trade, in the hands of the recipient, there will be 45(2) getting triggered and PGBP getting triggered. Yes or no? Are we clear? Is this absolutely clear to you? Yes or no? All of you, please be together with me. Yes, online students, Zoom students, is this absolutely clear? Okay. Next section. Amalgamation. Now, what is amalgamation, students? All of you know about it. What happens in the case of amalgamation? So, let's say, for example, there is a company A. This will amalgamate with the company B. Now, definition of amalgamation is given under the Income Tax Act itself. The definition of amalgamation is given under the Income Tax Act, which is under which section? Under section 21B of the Income Tax Act. What does it say? So let me put the definition for you here only so that you have the definition in front of you. Okay. So amalgamation is defined under section 21B. So how is it defined? Let's see. So amalgamation in relation to the companies means the merger of one or more companies. The merger of one or more company with another company, or the merger of 2 or more companies to form one company in such a manner that all the property of the amalgamating company or companies immediately before the amalgamation become the property of the amalgamated company. So all the property of the amalgamating company become the property of the amalgamated company. All the liabilities of the amalgamating company become the liabilities of the amalgamated company. Shareholders not less than 3/4 in value of the shares. Shareholders holding more than 75% of the shares become the shareholders of the amalgamated company. Then in that particular case, it is considered as amalgamation as per the Income Tax Act. Are we clear? So this will be considered as amalgamation as per the Income Tax Act. Clear? So in that particular case, this will be considered as amalgamation as per Income Tax Act. So what is the definition saying? All property and liabilities of amalgamating company become property and liabilities of amalgamated company. I'm writing in a short form here. Okay, you don't have to write like this in exam. Then secondly, the shareholders holding greater than equal to 3/4 in value of shares of the amalgamating company become shareholders in amalgamated company. Fine. Now, when this amalgamation will take place, two things will happen, student. Number one, the assets of this ACO will also be transferred to BCO. The assets of the ACO will also be transferred to BCO. So, if during the course of amalgamation, ACO transfers the assets to BCO, this is not considered as transfer under section 47(6) of the Income Tax Act. Are we clear? So, if during the course of the amalgamation, if the assets, because it says all the property of the amalgamating company should become the property of amalgamated company. So, automatically my capital assets are transferred from ACO to BCO. So, this is not considered as transfer under 47(6). So, 47(6) exempts this particular kind of transfer. Are we clear? Now, what will be the value of this particular capital asset in the hands of the amalgamated company? Yes, what will be the value of the asset? Yes, what will be the value of this asset in the hands of company B? What will be the cost of acquisition for company B? There is no consideration, Mika. B is not giving any consideration for the capital asset per se. Amounts as per books? No, Vignesh. It is the cost to the previous owner under section 49(1). So this is cost to the previous owner. Are we clear? What will be my period of holding of this capital asset? So there will be again clubbing of period of holding. Yes, are we clear about this point? So for company B, the cost of acquisition will be the cost to the previous owner. Period of holding will be clubbed as per the explanation 1 to section 242A. And there will be indexation also clubbed, right? As per Manjula Shah. Are we clear? Now, in the hands of B, when it is receiving the capital asset, again 56 to 10 will not be applicable. So 56 to 10 is not applicable because of the specific exemption. So just like 47(4) and 47(5), where 56 to 10 was not applicable, here also, when the capital asset is received by the amalgamated company from the amalgamating company, 56 to 10 exempts that specifically. Yes, are we clear? Okay. So 56 to 10 will not be applicable. Now, what will happen in the case of amalgamation? In the case of amalgamation specifically, so this particular company B, will give the shares to the shareholders of the A. Right? So to the shareholders of the A, the company B will give the shares in the company B. Right? Plus it may give some cash. So the consideration for the amalgamation is paid to the shareholders because A company is died. It is over. It has amalgamated to B. So now company B will issue the shares to the shareholders of A because what is the condition? Not less than 3/4 of the shareholders should become shareholders in company B. So company B has to issue the shares to company A's shareholder. Now shareholders of company A, why are they getting consideration from B? Because they were holding shares in A. The company A has now amalgamated with B. The company A died. So there is an extinguishment of shareholding right in A. So the shareholders' right of holding in A is extinguished. Isn't it? So therefore, there is your extinguishment of shareholding which is there in A. And that is the reason why they are getting the consideration from B. Now, extinguishment of shareholding is transfer under 247. Transfer includes extinguishment of any rights, isn't it? But section 47(7) says this will not be regarded as transfer. So 47(7) says this is not transfer under section 47(7). However, the consideration which is paid in cash, for that there is no exemption. So when you get the cash consideration in the hands of shareholder, there will be the taxability. So my full value of consideration will be my cash consideration. The cost of acquisition will be the cost of A's share. Period of holding will be my period of holding of A's shares. And so is the indexation. Are we clear? Yes. Any questions? Any doubts so far? Have we understood this properly? Yes or no? Have you understood this? Okay. Now, yes.
In this case, the shareholders of A receiving shares and cash for the purpose for the computation of capital gains, you take FEC for only cash consideration only. Why, ma'am?
Only cash consideration. See,
Share
they
fee
may, yeah, see, the shareholders of A may get shares of B plus some additional cash consideration. So the cash consideration will be taxable, but what you receive as shares will not be taxable under 47(7).
Okay, thank you.
Okay. Now, what will be the cost of acquisition of these shares for the shareholders? Now, let's say I'm a shareholder. I receive the shares of company B and now I want to sell those shares. So what will be the cost of acquisition of these shares? So this is shares of B. Okay. Now, what will be the cost of these shares? The cost of acquisition for a shareholder will be the cost of shares of the A. So the cost of acquisition will be the cost of shares of the amalgamating company. That is in our case A. My period of holding of B's share will include the period of holding of amalgamating company share, that is of A. And so will be for the indexation. Are we clear? Yes or no? Any question? Any doubt so far? Okay. So this is section 47.4, 47.6 and 47.7. Are we clear? Okay. Now, some few other points from the perspective of amalgamation. In case of a depreciable asset transferred by the amalgamating company to the amalgamated company, what will be the cost of asset to the amalgamated company for the purposes of depreciation? You have already done this as a part of your PGBP class. If I transfer a normal asset, it will be the cost to previous owner. But what about a depreciable asset? What will be the cost in the books of the amalgamated company for depreciation? It will be the WDV. It will be WDV of asset to the amalgamating company. It will be WDV of asset to the amalgamating company. And therefore, the depreciation is to be allowed proportionately. Depreciation is to be allowed proportionately based on number of days asset is used by both companies. Have you done this point or not? Yes or no? Yes? Have you done this point in PGBP? Yes. Okay. Then this you will do in the chapter 6A deduction class. Section ATIA, ATIB or 10AA deduction, which was allowed to the amalgamating company, will also be now available to amalgamated company. So I'm just consolidating everything over here. Losses of amalgamating company under section 72A, we have a provision for that. This also you will learn in the set off and carry forward of losses. So losses and unabsorbed depreciation of the amalgamating company shall be deemed to be the loss and unabsorbed depreciation of the amalgamated company for fresh 8 years. So you know that the business losses can be carried forward only for 8 years, but after the amalgamation, you will get another 8 years. It is not that you will be allowed only for the balance period which is remaining from 8 years. No, it will be allowed for a fresh period of 8 years to the amalgamated company. Are we clear? But there are conditions which you will learn in the set off and carry forward class, that the amalgamating company should be an industrial undertaking, which means that it should be in the manufacturing of goods, computer software, generation and distribution of electricity, telecom, mining. It should be either operating in the business of running ships, hotels, bank, public sector company. The amalgamating company should be engaged in business for more than 3 years and should have held 3/4 of the book value of assets for greater than equal to 2 years. The amalgamated company should also hold the 3/4 of the book value of assets for greater than 5 years and should continue the same business for another 5 years and should achieve the 50% of the capacity, installed capacity, as the level of production for more than 5 years. If you violate any of these conditions, then the unabsorbed depreciation and the business loss shall be deemed to be the income of the amalgamated company. Yes, are we clear about this? I'm not writing conditions over here, but this you will learn in the set off and carry forward class. Yes or no? Any question? Any doubt? Yes. So, today we have done the amalgamation and the business transfer. What we will be doing in the next classes? We will be doing demerger, we will be doing the slump sale, and we will be doing the conversion of company, sole proprietary concern to company, or conversion of firm to company, or conversion of company to LLP. Right? And also in the next class, we will take care of the computation part. How do we compute the capital gain? Because that is now very, very important. And what will be our tax rates? Is there any question or doubt so far? Yes? Any doubts, any question? Any concept that you have not understood so far? No doubts, no questions? Okay. So just a quick recap of the amalgamation. Amalgamation, when the capital asset is transferred, there is no capital gain under 47(6). It is not a transfer. In the hands of the recipient company also, there is no 56(2)(10). What will be the cost of that asset? The cost to the previous owner. Period of holding, you will club off the previous owner. In case it's a depreciable asset, you will consider the WDV of that asset in the books of amalgamation. And you will allocate the depreciation in that year on proportional basis based on the number of days the asset is used. Clear? For the shareholder who is receiving the consideration from the amalgamated company in the form of shares of that company, again, it will not be regarded as transfer under 47(7). Are we clear? And if the consideration is received in cash, then in that case, you will calculate the capital gain. But if the consideration is received in shares, there is no capital gain in that case. Are we clear? So this is the amalgamation provision which is there under 47. The losses of the amalgamating company are available to the amalgamated company, unabsorbed depreciation also, and the losses for the fresh period of 8 years. Clear? So, thank you so much, Oja, I really want you to remember these sections, and that's the reason why we are repetiting a lot. Also, I want you to please quick revise every night before you sleep, because that will help you consolidate everything. And in the next class also, when you sit for the class, spend 15 minutes to revise everything. So then what will happen is, students, you will be able to consolidate, you will not forget. DT is so vast that you tend to forget the things. There are small provisions, and it will be tested like that in exam. There will be small adjustments that may not click in the exam. But if your concepts are clearer, if you are writing these things, it will make everything easy on the exam day. And the practice is the key to the exams. So as far as possible, study the subject in a very basic manner so that you are able to remember at the exam, and you will score like anything. Are we clear? So thank you so much, and see you in the next class. Thank you. Yes. Thank you. Good night.